Hi, I'm Aaron Newworth with ETF Trends and ETF Database. I'm joined once again by Chris Huemmer, Senior Investment Strategist at FlexShares Exchange Traded Funds. How are you doing, Chris?
Great. Thanks for having me again, Aaron.
For sure. Here we go. There has been an increased interest in low volatility products recently, with equity markets hitting new highs. What is driving this resurgent interest?
Yeah, absolutely. Let's start with our base case. Our base case at Northern Trust is that growth will slow, but it will be sustainable. And that for us is an overall positive for risk assets. But one thing that we have noted is that there is and will, in our minds, be an increase in volatility coming forward. And there's several issues for this. We are seeing quarter-over-quarter GDP growth forecasts come down. In August, they were for the third quarter 7.6%. We're in the period, we're in the reporting period already, but that third quarter growth has already been truncated to 3.4%. So really, that is adding volatility to markets to a certain extent, even if they have been generally going up. Additionally, we're seeing the outlet for interest rates dramatically shift over the last several days. The pace of the taper and questions of when that first rate hike might be is definitely having an impact in fixed income and on the rate curve. And that is also has the potential of having an influence on the equity market over the long run. If you think about what are the reasons that are driving that increase in rates, typically there's two reasons: either increase in growth expectations and robustness of the economy, which is a good reason for rates to be going up. If it's being driven by inflation, that would be a bad reason for rates to be going up. And if you look at the combination of, as I just talked about, slowing global growth, we're seeing some uptick in inflation metrics, whether you're looking at it from a wage standpoint. Obviously, we've seen supply chain constraints, which have driven commodity prices higher. Expectation is that housing prices will continue to go up. So owner equivalent rent, which is a key component of CPI and PCE inflation metrics, will continue to go up. And so with all of that in mind, we're seeing this shift from we're not at a point where the consensus view is that we're moving away from that transitory view of inflation, but we're seeing less consensus around that transitory view than we have seen in the future. And I think all of those reasons are a cause for investors to be still positive on risk assets, but potentially looking at things like low volatility as a way to be invested in risk assets, but being able to hopefully absorb some of the shocks that we see in markets going forward.
You've also talked about how quality has experienced two different environments this year. Can you elaborate?
Yeah, absolutely. The beginning of this year, we saw essentially a rising tide raising all ships. Basically, we saw cheap, low quality companies that had the most room to kind of recover, outperform at the beginning of the year. But since February, we've seen a shift as the recovery has shifted into a more mature phase. We've seen investors become more discerning in their view of companies, and we've seen this change in their view of quality companies. So when we talk about quality, we talk about companies that are financially strong. Typically, they're companies that have strong profitability, have robust cash flows, and manage their external financing and their capital expenditure decisions pretty conservatively. Those companies that tend to be in that high quality bucket have outperformed the poorest quality bucket by 500 basis points in the US since the beginning of February. So we're definitely seeing that quality companies are going on a little bit of a run. And as we look forward and we look at labor and supply chain costs continuing to trend higher, we would expect that these high quality companies should outperform in those environments as well. The other thing I would say is that the interesting thing is the impact of quality on some of the factors we look at. So when we look at things like value or low volatility, a factor like value has kind of ebbed and flowed this year, and growth has kind of retaken over value by outperforming value. But however you break that between high quality names and low quality names, high quality value has outperformed the general space, and really where the underperformance is coming from is low quality value names. And we see a similar thing in low volatility, where high quality low vol names are outperforming the general market and general low volatility in general.
You've spoken in the past about sector neutrality as a key consideration when looking at low volatility strategies and understanding their performance. Why do you believe that a sector neutral approach is the best way to invest in low volatility?
First and foremost, we have a foundational belief that you need to be compensated for the risks you are taking. And when it comes to large sector overweights and underweights, generally over the long run, they do not turn to be a compensated risk. When we're talking about in the context of low volatility, you're essentially, when you are taking unconstrained low volatility exposure, you're essentially trading one risk, general volatility of the market, for a different risk, the idiosyncratic sector bets that you're taking in the market. Right now, that is particularly important because when we talk about interest rates and the potential for interest rates going higher, and when you look at the view of markets, there has been a trend towards interest rates rising faster sooner, particularly when you look at low volatility sectors that get overweighted in unconstrained portfolios, things like utilities, consumer staples. Those are sectors that are extremely interest rate sensitive. So in an environment when interest rates are going up, you might underperform because of your exposure to interest rates and not because of what's happening in the low volatility space. I think that's also something we saw from a 2020 perspective, and a view that low volatility underperformed. I would say that if those are mostly using unconstrained portfolios, those portfolios that were drastically underweight sectors like utilities that underperformed in 2020, those were the portfolios that tended to underperform dramatically and end up in negative territory for 2020, where while low vol in general underperformed as the markets recovered for 2020, a more sector neutral approach tended to do better than an unconstrained approach.
Great. Well, thank you, Chris. We appreciate your insights and look forward to chatting again soon.
Thanks, Aaron. Thanks for having me.